Hi, and welcome back to The Explainer. It's Thursday, 20th of August, 2026, and I want to talk about the bond market. Maybe quite an arcane topic, but actually very important in terms of the cost of capital for us all, and actually also for equity markets. And I want to tell you that at the moment, the bond market in the US particularly, and also globally, is coming under strain. And the reasons for that are really twofold. Primarily, the level of debt held by governments globally, and particularly in the US, and the budget deficits governments are running, and also inflation. In terms of the debt load, first of all, in the States, the total government debt has just gone through 40 trillion US dollars, which is about 125% of GDP. And if you think about that $40 trillion debt load, interest rates are give or take 4-5% in the States. So take 5%, that's $2 trillion of interest costs per annum. The US defense budget is $1 trillion. So double the US defense budget now. And that debt load has itself doubled in the last few years. Partly as the level of debt has gone up, and partly as interest rates have gone up. If you take back to COVID, 6 years ago now, interest rates at the long end, kind of 20, 30 years, were broadly 1% globally and in the States. Today, those same 30-year interest rates at the long end of the bond market are close to 6%. 5.3% in the States, close to 6% in the UK. And so that debt load has become troublesome, and the bond market is starting to take that strain. And secondly, inflation. Inflation has been above the Federal Reserve's target of 2% in America for 5 or 6 years now. And it's running, broadly speaking, at 3.5%, maybe 4%. And again, that'll undermine the value of your bond in terms of its nominal coupon. So strains in the bond market, what are the implications? I'll just highlight two. I think firstly, we are going to see probably higher inflation for a fair while, because one way of deflating the level of debt in real terms is to let inflation run hot and the real value of your debt decreases over time. So that's one way to kind of solve the debt problem. So I think we're going to see in the Fed allow inflation to run a little higher. So expect that to continue, which is not a great outcome, but it probably is the outcome. And secondly, in terms of the cost of capital, you're also seeing an enormous amount being raised by the hyperscalers for the AI boom. So trillions of dollars being raised by the cloud providers and the model providers, be it Microsoft or Meta or Google, Anthropic, OpenAI, etc., and NVIDIA. And so the cash flow of these previously very cash-generative tech companies like Meta and Microsoft, that free cash flow is now all going into AI spend and build and more. And so they are raising a lot more money in the corporate bond market, and the cost of that debt is going up. And that has a direct see-through in terms of the equity market and the valuations of these companies. And so this AI build-out is much more dependent on debt financing and infrastructure spend and capex spend than previous tech booms, which have been quite capex light. And so there's a thread running through this in terms of the ongoing sustainability of what's driving growth at the moment, which is AI. And so just some creaks in the market. I certainly wouldn't want to get too bearish about it, but just be aware of the importance of cost of capital to this whole story. Keep an eye on the bond market. And we just saw this week Scott Bessent in the States, the US Treasury Secretary, doubling the purchases of bonds at the long end from $2 billion a month to $4 billion a month. That's an attempt to keep yields down, so-called yield curve control, which shows that the US government is also worried about the level of debt and the interest rates having to be paid on that debt in terms of their own debt load. So keep an eye on these things, and could become a fast-moving situation. At the moment, it's kind of a slow-moving situation, but one to keep an eye on. Hope that was helpful. Catch you soon.